have a pen and copy with you, it helps a lot. And noting down all the important things, and also turn on your cameras. Most of you have, so that's a great thing. And let's get started with this last interesting topic. Yeah, Akshay.
एक सेकंड यार, मैं शेयर कर रहा हूँ एक बार.
हाँ जी.
Once I have my screen sorted. I got some feedback from the earlier session that some people were not comfortable in Hindi. So I would like to keep this session only in English. All right. So I will not shift to Hindi anymore. Is it visible?
Yeah, we can see the screen.
एक second. Let me just set the screen in the correct way so that I can see the chat. Plus, I want to see all of you as well. Sandeep is saying Hindi and English mix. Sir, the problem is that people who are comfortable in Hindi, they also understand English. But there are a lot of people from, let's say, southern states of India who are not at all comfortable in Hindi. So I would like to keep it in English. If, let's say, you've not understood anything, any particular query is there, any particular doubt is there, you can let me know in the chat, and I'll then try to repeat that answer in Hindi. Okay? All right, awesome. So one second, let me just go back. I'll just quickly do a revision for IPO investing. What did we learn in the morning? What did we learn in the morning? In the morning, we learned that one, you first have to understand the basic difference between the investing mindset and the trading mindset. When you're investing in IPOs, you should have a clarity. You should have clarity. What are your objectives? What do you want to do in that IPO? Do you want to hold it for the long term, or do you want to take listing gains and exit, right? If you want to hold it for the long term, this is the framework to follow. This is the framework to follow, which is first you have to study the company using the SCRAP framework. Now, SCRAP framework, I understand it. All of you might not be comfortable with it because people who attended the multi-bagger bootcamp, they are very comfortable with it. People who are, let's say, who did not attend, for them, I'm just giving a quick revision of that, or let's say a quick summary of that. SCRAP framework is consisting of 5 elements. 5 elements: sector, company analysis, rejection criteria, allocation strategy, and psychology, right? Sector analysis, what we do is we understand how big is the sector, how fast is it growing. We look at some metrics and understand whether the sector is growing fast enough or not. Second, we also understand themes that are happening in that sector, whether there is value migration happening or not, right? So that becomes very, very important. For multi-bagger returns, you should not be taking a bet against the trend, right? You always have to follow the trend which is happening in the overall economy. You always have to take the trend in favor of value migration, all right? That's sector analysis. Then comes company analysis. Company analysis, there are a couple of metrics that we study. I will also pick up these metrics in the session that we are going to conduct, some of these metrics, and I'll try to teach you how to read these metrics, what is the meaning of these metrics, and how they can help you in figuring out good companies on Screener, right? I'll tell you that. Company analysis also involves a subjective study of the competitive advantage of the company, or let's say moats. Moats are nothing but competitive advantages of the company, which help the company in growing much faster in comparison to their rivals, or keep on growing indefinitely, keep on growing for a longer time compared to their competitors, right? Keep on gaining market share of that particular sector, right? So that's moat analysis. Then rejection, R is the rejection criteria. We study a list of red flags. If the red flags are there in the company, we do not invest in the company for the long term. Then there's allocation strategy, and then there is psychology. Allocation strategy is nothing but we have created a strategy how to allocate X amount of money across, let's say, 10 different, 15 different, 20 different stocks. And how do we keep on reshuffling that as and when time goes by, right? And P is the psychology. We also spend like almost one entire session on learning what are the different kind of biases that can impact long-term investing, right? So that's the SCRAP framework. If you are investing in an IPO, if you're investing in an IPO for a long-term perspective, these are the 4 or 5 things that you have to do. One is read the DRHP. DRHP is the draft red herring process. Draft red herring process is the Prospectus is the document submitted by the company to SEBI once they are in the IPO process, before the IPO process starts actually, right? So DRHP contains very valuable information on the sector in which they are operating, what kind of business they are doing, also the business past data, right? So 3 things you get very, very interestingly from DRHP: sector. In fact, a lot of sector analysis is done by reading the DRHP of new IPOs. All right. So that's also a very interesting document that you can read just to get a sense of what is happening in the sector. Right. So DRHP is a very interesting document. You get sector analysis done in the DRHP. You get company analysis. What is the business doing? How are they operating? And third, past financial data of the business in the DRHP you get, right? So that is very important to read if you're investing in IPO. Then you get a market understanding. Of course, market understanding and business understanding you will anyway get from DRHP. Moat analysis. Moat analysis you have to do on your own, right? I'll talk about 2 moats which are specific to new age tech companies. There are 9 different kind of moats which we cover in detail in the bootcamp. We don't have time to cover that right now. I'll specifically talk about 2 moats which new age companies have, and I'll go into detail of that, right? And 5th is the red flags. Does the company which is coming up with IPO have any red flag, have any, let's say, metric on which they are faring very badly, and that's why we should not go ahead and invest in that, right? Now that's for the long-term perspective. We add another factor if we are investing in IPO, which is total subscription of more than 30 times. So oversubscription of more than 30 times. Total oversubscription of more than 30 times. If you are just doing it for the listing day gains, do not study the fundamentals. Only see whether the company got oversubscription of more than 30 times. Invest in that. 99% chances are there from the past data. 99% chances are there that you will get gain on listing day. Opening gain, you will definitely get. 99% chances are there. Closing day gain might not be there. That's why you have to exit. You have to exit. You have to, as soon as, let's say, the listing day starts, maybe by 11 or 12, you should exit. Okay? If you've got listing day gains. That's from a trading mentality. If you have an investing mentality, study the company first through the scrap frame. All right. Awesome. This I already told you. Are there any specific questions related to IPOs before I go to the new age companies? You can raise your hand also, and I'll just maybe take 2 questions here. Only 2 questions. If you have any specific questions related to IPO, then please raise your hand. I'll allow you to unmute yourself.
लाल बिहारी सर का है पहले तो क्वेश्चन.
Mr. Siddharth also has a question.
Yeah.
Hello.
Yes, sir. Hi.
Hello, sir. Sir, I have a question. Can we invest in a startup? Is there any platform available right now?
So there are platforms that are coming up for let's say giving an option to retail investors to invest in startups also, even before they get listed on let's say the stock exchange. But personally, I would not advise you to go in that direction.
Okay, sir.
Personally, and the reason is, I'll tell you why. All the good startups, all the amazing startups will not come to retail investors for funding. That's for sure.
Okay.
Right? You understand? जितने भी अच्छे startups हैं, वो retail investor के पास नहीं आएंगे funding में, क्योंकि उनको funding VC से मिल जाती है. ठीक है. तो और startup world में क्या होता है? Success सिर्फ let's say मिलती है only 1 to 5% of the startups. 1 to 5% of the startups become really big, right? Mostly जो retail investors के पास startup आएंगे, जो platforms पे list होंगे, normally वो अच्छी quality के नहीं होंगे, या फिर उनको funding VC से नहीं मिल रही, इसलिए वो आपके पास आए हैं, right? दूसरा, retail investors don't have the mental models to analyze a company at a very early stage, right? If I invest in startups, I mostly do at least 5 to 6 meetings with the founder, and then I put my money, right? I understand it really well. Now, if you are putting small ticket size, you might not be able to devote that much time, and the founder also might not give that opportunity to you, right? So more or less, I would recommend, if you do not have a very good understanding of the business, if you do not know the founder personally, then do not go ahead and invest in startups. Also, there are so many opportunities in listed space also. There are so many companies which we have seen also in the bootcamp that can become, let's say, multi-baggers, that can give, let's say, 50x, 100x returns, right? So we need not go into the startup space because it's slightly risky. Also, you don't have the right framework to actually apply to invest in startups, right? Awesome. Thank you. Siddhartha, you can ask your question. I'll allow you to unmute. Yeah. Hey.
Good evening, sir.
Good evening.
Yeah, actually, I have that Excel that you showed us in the morning. So
Yes.
if you can just share it with us, I just want
Why
to
not? Why not? I'll share the link on
And
community.
one more feedback or request is there. If you can add a book section to your community section, book reference books for link. That will be better.
We'll do that. We'll do that. So let's add a book club in the community
Yes.
as well. I will also keep on sharing whatever I learn from
We can
books.
also share if we are having any.
Definitely, I'll share. Definitely, I'll share. Also, I would appreciate if every one of you, whenever you read a book, just put a summary in that book club, and it will benefit everyone. And you will also get benefited when others put it.
Yeah. Thank you.
All right. Awesome. Any more question, Mayur? Yeah. So Mayur, you can ask your question. I'm just allowing you to unmute. Yes, Mayur.
Mayur, we can't hear you, but
हाँ सर, सुन रहा है क्या?
हाँ जी, सुन रहे हैं.
हाँ जी.
हाँ सर, मुझे यह पूछना था कि लिस्टिंग एंड का मतलब वो किस पे डिपेंड करता है? मतलब
लिस्टिंग डे किस पे डिपेंड करता है?
नहीं, लिस्टिंग गेन मतलब वो काय पे डिपेंड करता है? मतलब किनके हाथ में होता है कि मतलब लिस्टिंग गेन होगा या नहीं होगा?
वेरी गुड. तो बहुत बेसिक क्वेश्चन है आपका, मैं आपको समझाता हूँ. देखिए, जब कंपनी आईपीओ के लिए अप्लाई करती है, कंपनी जब आईपीओ लेके आती है, तो उस टाइम पे जो प्राइस डिसाइड होता है वो कंपनी की तरफ से होता है.
ओके.
कंपनी बोलती है कि मेरे पास लेट्स से 1 करोड़ शेयर्स हैं और मैं 1 करोड़ शेयर्स बेचना चाहती हूँ ₹100 पर शेयर के प्राइस पे.
हाँ,
₹100 पर शेयर पे प्राइस पे. तो 100 करोड़ वो मार्केट से उठाना चाहते हैं.
बराबर.
ठीक है. तो 100 करोड़ के शेयर्स के लिए लोग अप्लाई करेंगे. ठीक है. मान लीजिए 100 करोड़ के जितना भी उनका लॉट था, जितना भी उनका जैसे आस्क था कंपनी का, उससे ज्यादा लोगों ने अप्लाई कर दिया. सो पीपल ओवर सब्सक्राइब्ड, राइट? तो वो 100 करोड़ तो पहले कंपनी को मिल गया,
राइट?
तब कंपनी गेम से बाहर हो गई है, राइट? दिस इज द प्राइमरी मार्केट. प्राइमरी मार्केट इज व्हेन मनी इज गोइंग टू द कंपनी डायरेक्टली. सो 1 crore shares got issued to retail investors and 100 crore went to the company.
Right.
100 crore went to the company, right? Now company is out of the game. After that, listing happens. Listing happens on the stock exchange, right?
Right.
That is where the secondary market starts. Secondary market means you can trade. You can sell your whatever shares you are now owning. You can sell those shares to anyone in the market. That is where retail investors get involved, right? They buy and sell shares, right? Now, according to the supply and demand in the secondary market, in the stock exchange, company now has nothing to do with it. Whatever is the supply, whatever is the demand, according to that, price keeps moving.
हाँ सर, लेकिन जैसे अभी 100 रुपए पे समझो कंपनी ने इशू किया, लेकिन लिस्टिंग के टाइम कभी-कभी 500 पे भी लिस्ट होता है. तो उसके बाद तो और वो बढ़ता है या कम होता है, वो तो सेकेंडरी मार्केट उसके बाद रोल प्ले करता है. लेकिन वो इशू प्राइस से कैसे बढ़ जाता है वो?
Very good, very good. So I'll tell you one interesting fact which most of the people will not know. For IPO listing companies, trading starts at 10 a.m. in the morning.
Right.
Did you guys knew this?
Yes, I know.
Trading starts at 10 a.m. Trading does not start at 9:30. For all other stocks, trading starts at 9:30. Right? Before 10 a.m., in the 30 minutes, 45 minute session, people place limit orders.
Right.
Buying and selling. Based on those orders, the listing day price will get started.
Okay, मतलब demand and supply पे बेस होता है.
Correct. It's based on supply, demand and supply only, right?
Okay.
Someone mentioned in the chat it is gray market price. Gray market price नहीं होता है. Gray market price can impact the listing day price because people will place limit orders accordingly. But the listing price is actually decided by the supply and demand of the limit orders that get placed before 10 a.m.
Okay.
All right.
ओके। और सर ये मतलब वो उसमें कुछ ऐसा ट्रिक होता है क्या कि लॉट मतलब जैसे HNI में अप्लाई करो या फिर रिटेल कोटा में अप्लाई करो, उसमें रिटेल कोटा में भी 12 से 13 लॉट अप्लाई कर सकते हैं और HNI में 2 लाख से ऊपर अप्लाई कर सकते हैं, तो उसमें ऐसा कुछ क्राइटेरिया होता है क्या कि समझो अभी जैसा HNI कोटा में 20 टाइम्स सब्सक्राइब हुआ, तो अगर मैंने 20 लॉट लगाए HNI में तो फिर उसमें से
I'll tell you, ज्यादा लॉट्स लगाना डज नॉट मीन कि आपको लॉट मिल जाएगा।
ओके।
तो ये भी गलती मत करना, राइट? इफ द IPO is oversubscribed, if the IPO is oversubscribed,
okay,
the preference given by the company is let's give one lot to everyone.
हाँ मतलब वो क्राइटेरिया नहीं रहता, मतलब कितने भी लॉट लगाओ एक ही मिलना है ज्यादा से ज्यादा,
आपको एक ही मिलेगा।
ओके ओके।
तो आपको ज्यादा लॉट नहीं लगाने हैं, आपको एक ही लॉट लगाना है, फायदा नहीं है कोई। अगर आप इफ यू वांट टू इंक्रीज योर चांसेस, you should apply through different PAN cards.
Okay, okay.
So if you, let's say your mother, your sister, your wife, whoever has a Demat account, you can apply through them.
Okay, right. Okay, sir. Thank you.
Awesome, great, fantastic. So let's move ahead now. I'll just take like one last question, which is by Praveena. Yes.
Hello, hi. My question was, which day do we check the oversubscription numbers? You said something about day 1, day 2, day 3.
We check the oversubscription on third day.
Okay.
So if let's say the oversubscription of the first 2 days was more than 30, you can apply. You can apply then on the third day.
If the oversubscription is over 30, we can what?
You can apply on the third day.
Okay, got it. Thank you.
Yeah, very, very simple. Yeah, awesome, great. Let's move ahead now. Nikhil, Pawan, I know your hands are raised, but I'll take your questions in the end. All right, let's move ahead. Awesome. So now we have to analyze new age startups. New age startups, right? We'll try to cover this in like 20 minutes. All right. Now there are a lot of new age companies that are coming up, and 2010 to 2021 has been, let's say, this decade has been the decade of Indian internet startups, right? Most of the growth in the economy, has been fueled by Indian internet companies in the last 10 years. Because I've been a participant of that also, and a very active participant of that also, I can tell you with guarantee that this growth is not going to stop here. This growth will at least continue for the next 2 decades, right? Last 10 years was just laying the seeds of the ecosystem, right? Now companies are maturing, founders are maturing. When we started up in, let's say, 2014, 2015, we did not have any idea about tech ecosystem or let's say about the startup ecosystem. The investors that I was pitching to in 2015, they also did not have any idea about the startup ecosystem. But in 6 years, it has grown so much, it has matured so much, and so much value has been created, right? So this is not going to stop. This is going to continue. We as investors, we as retail investors, now is a good time for you to get a strong grasp of how do we understand, how do we make sense of these new age tech companies? Because the models that are there, the financial models that are there, the frameworks that are there, which apply on factory companies, they do not apply on new age tech companies. You have to like understand their core business. You have to understand how they grow so quickly, and which companies are going to become, let's say, the big winners in the stock market as well, right? So I'll cover like key points here. I'll not go into details of it. First of all, I'll cover 2 modes, 2 competitive advantages, which you have to understand really, really well if you have to understand startups. 2 competitive advantages, 2 modes, which you have to understand really well. The first mode is economies of scale or cost advantage. Economies of scale or cost advantage. Right? What does this mean? There are some companies, there are some businesses, there are some sectors where if you scale, you get an extra advantage over your competition, either in terms of, let's say, cost or, let's say, value. I'll tell you that. I'll tell you how, right? How many of you here understand the business model of DMart? What is the business model of DMart? How is DMart able to grow so fast? Don't know. Right?
Some should some should to answer who have already like studied this with Akshay, and I was expecting like some to answer.
Bulk purchasing. All right, so I'll answer. I'll actually, Arvind, are you here? I can't see you.
Yeah, I'm here.
Awesome. So I'll just maybe do a one-on-one discussion with you. All right.
Yeah.
So DMart actually is in the business of retail, right? Retail, opening up retail stores and selling a lot of, let's say, groceries, appliances, electronics, etc., right? Now, what happens is DMart as of now has more than 150 stores. 150 superstores across India. 150 superstores across India, right? Now, let's say they have to sell biscuits. They have to sell biscuits in these superstores, right? Let's take a particular brand. Let's take Parle G. Right? So Parle G is a 10 rupees biscuit, right? तो उनको वो बेच रहे हैं. Now, when you go to a normal Kiryana store, that Parle G biscuit is of rupees 10. The Kiryana store buys it at rupees 8 or 9 and then sells it to you at rupees 10. He makes a 1 or 2 rupees margin, right? 1 or 2 rupees margin. DMart plays this game very differently. How do they play this game? They say, because I have 150 superstores and I have so much demand, I will go directly to Parle G, or I'll go directly to Parle. I'll go directly to Parle. I will place an order for 1 lakh biscuit packets.
Okay.
So one is I'll place the order of 1 lakh biscuit packets. Second, I will pay in advance. I'll pay in advance. I don't have any cash issue. I have a lot of, I don't want to take things on credit. I'll actually pay in advance, right? And I'll pick up like 1 lakh Parle G biscuits, right? Now, based on these two negotiating powers, right? They'll actually purchase Parle G biscuit at rupees 5 or 6. Parle will be happy because one, they're getting a bulk order. Second, they're actually getting advance. Otherwise, their money gets stuck. If let's say you go through the distributor route, their money gets stuck because the Kiryana store does not pay the distributor does not pay Parle, and their money is anyway stuck, right? You don't get the money, let's say for 60 days, for 90 days, for 120 days, right? The money is anyway stuck, right? So they're getting advance payment plus they're getting a bulk order. They are really happy. They can actually sell at rupees 5 or 6 also, right? DMart procures these biscuits at 5 or 6. They sell it to you, the customer, at rupees 8. Customer becomes happy, right? Parle is anyway happy. DMart is making a 2 rupees, 3 rupees profit. They are also happy, right? So this game is actually called economies of scale, because with scale, what happens is their negotiation power becomes even stronger and stronger. If I have to compete with DMart, I have to first open 150 stores, reach their level to get that negotiating power, which I can't do right now. By the time I'll open 150 stores, they'll open 150 more, even more. Right? So with scale, what happens is they continue to, let's say, purchase even items in even more bulk. Plus, they can continue to use their, let's say, cash advantage, whatever cash muscle that they have built, to negotiate with the suppliers, to negotiate with the manufacturers, and they'll continue to drive down the costs of procurement. Same thing Jio did. Right? So what is the cost for a telecom company? The cost is anyway fixed. Right?
It's expenditure of towers and all this stuff.
Exactly. The fixed cost is anyway fixed, the fixed cost of infrastructure, right? So the cost per new network keeps on decreasing as and when you keep getting more networks, or let's say as and when you keep getting more connections. I'm so sorry. Cost per a new connection, right? Cost per a new, let's say, mobile connection or a mobile number keeps on decreasing as and when you keep getting more connections, right? So that's what Jio played into, right? So for the first 1 or 2 years, they suffered losses, but after that, because their cost came down so much, they were able to, let's say, continue their prices. They kept their prices low for a very long time, and even I think even right now, Jio is the cheapest among Airtel and Vodafone, right? So, and this happens across industries, specifically in tech industries. What happens is the tech infrastructure does not cost anything. tech infrastructure does not cost anything. It's like peanuts. It's like peanuts, right? The development cost is there, but that development cost is fixed because you only need, let's say, 30 very super smart developers to create a platform, to create, let's say, a tech ecosystem, or let's say to create a tech company. But that is fixed. But because tech can scale really well, that fixed cost gets divided and you can offer anything and everything at a much lower price compared to offline. This happens across distribution, across logistics, across anything that you pick up. That's where there has been a larger value migration that is happening from offline to online in every domain that you can think of. Every domain that you can think of, there is a value migration happening from offline to online. Any domain you can name it, I'll tell you there is value migration happening, right? Healthcare mein ho gaya. I told you DocsApp, right? We started off in 2015 and it is already complete now, right? I'll just give you a number, like the sense of scale that we were able to achieve. Apollo Hospitals has 60 hospitals, 60 like full-fledged hospitals and more than 100 primary care centers. So they have more than 100 primary care centers and more than 60 big hospitals. They do around 10,000 consultations a day. They consult 10,000 patients a day, right? DocsApp, when I left in 2018, they were doing 25,000 a day, right? Apollo built their brand in 40 years by spending almost like thousands of crores in infrastructure, whatever. DocsApp scaled to those heights in 3 years, right? So you can imagine the kind of scale that you can achieve with tech. Same is happening in education also. In fact, COVID became the inflection point. COVID became the tipping point for people to start living virtual lives. Everyone became virtual. Everyone like came on Zoom meetings and Google Meets, right? So economies of scale, you have to really understand. Whenever you are analyzing a new age tech company, always understand whether their costs are fixed and whether do they get cost advantage at scale or not. Do they get economies of scale advantage? Always understand that. Most of the tech companies have that advantage, right? If you're comparing one tech company with another tech company, understand where the fixed costs are even lower. All right, so that's the first mode that you have to understand. Second, and this is even more important, is the network effects. Right? Very important if you have to understand new age tech companies, right? Let's take an example here and then let's try to understand network effects in detail, right? I've taken an example of Uber here, but let's take some other example. If I have to ask you, and you need to mention that in the chat, all right? If I have to ask you, so let's take WhatsApp as an example, all right? Let's take WhatsApp as an example. In which of these scenarios, WhatsApp as a product will be more valuable to you, right? Scenario number one, WhatsApp is only used by 5% of India's population. Scenario number two, WhatsApp is used by 90% of India's population. Which scenario will WhatsApp be more valuable to you as a product? Scenario one or two? 90%. The reason is, what is the value that WhatsApp gives you? WhatsApp is a platform where you can actually message people, where you can, let's say, connect with people, where you can interact with people, right? If people are not even there, who do you interact with, right? So what happens is, as WhatsApp starts growing, let's say once WhatsApp crosses a certain threshold of number of users in India, it keeps becoming more and more valuable as more users join in. Right? So that's the standard definition of network effects. The product or the network becomes more valuable if more users join in. Right? Once that starts happening, there is no stopping that product. Right? There was a new messaging app that was launched last year, which is Signal. Right? There was a lot of hoopla around it. What happened to Signal? Nothing happened to Signal. Why? Because of very strong network effects of WhatsApp. You have to shift all the users of WhatsApp to Signal and then Signal can work. Otherwise, it won't work. आप एक या दो दोस्तों के लिए सिग्नल थोड़ी रखोगे यार, नहीं रखोगे. All your friends, all your relatives are on WhatsApp, right? So could not work, right? Then there are network effects, and similarly, all the social media like Facebook, etc., all communities are actually built on network effects only, right? Also works where supply and demand platforms are there, or let's say marketplaces are there. Marketplaces are there. How does it work in marketplaces? I'll tell you, I'll explain, right? Take the example of Uber. Take the example of Uber. Let's say I am the founder of Uber. Let's assume, right? And I have to launch a new city for Uber. I have to launch Uber in Jaipur, all right? Do I launch Uber in Jaipur with 50 drivers, or do I launch Uber in Jaipur with 50,000 drivers? What should I do? As a starting step, should I launch with 50 or should I launch with 50,000? The correct answer is 50,000. I'll tell you why. With 50 drivers, no one will actually ride on Uber. The problem is with 50 drivers, the waiting time for a cab will be very, very high. The waiting time for a cab will be very, very high because there are only 50 drivers, 50 cars in the city, right? The waiting time will be very, very high. If you increase the number of drivers, the waiting time decreases. The value that each customer is getting increases because you can get a ride very, very quickly, right? So the value increases, the number of rides will increase. More people will book Uber, right? If more people book Uber, the earning of the driver will increase, right? If the rides increase, the average earning of drivers will also increase. It will keep going up. If average earning of drivers increase, more drivers will sign up for Uber. More drivers will sign up for Uber, right? And as more drivers sign up, the value increases even further. And that's a flywheel effect. That's a network effect that will keep growing. So all marketplaces, Zomato, Swiggy, Flipkart, Amazon, all marketplaces have that network effect. Bring in more supply. Because supply is there, demand will come. Because demand keeps increasing, even more supply will come. And then they become like self-sufficient on the platform. It will keep growing like that. You don't have to do anything, right? If you ask me, can you like start another food delivery service and compete with Zomato, Swiggy? It's almost impossible. Almost impossible. Unless like I have a very differentiating product, which all the users of Zomato, all the restaurants of Zomato move towards me, right? But I cannot follow the same playbook and grow because there are very strong network effects in Zomato and Swiggy. All right. So always keep that in mind. Awesome. So framework to analyze new age companies is understand the business story first. Just note down these points or let's say take a screenshot. Otherwise the recording will anyway be shared, right? You have to understand the business story really, really well. Understand the business story really, really well. Now, what do I mean by business story? See, a lot gets written on startups also. Most of the times it's negative news. Startups paise gava raha hai, it's losing money, etc. I would always recommend whenever let's say you are thinking of analyzing a company, analyzing a tech company, start off with let's say watching interview or let's say watching a YouTube video of the founder or the team explaining what they are trying to do. Try to understand their scope or let's say their point of view first. I'll tell you, most of the times the journalists in India or the media in India is actually doesn't have any clue about what is happening in the tech ecosystem. They do not understand how growth happens. They do not understand how companies grow, right? So forget what they are actually writing. First, get a good understanding of the point of view of the founder first, what they want to build. You may not agree with it. That's completely okay. But try to get an understanding of what the team or the founder thinks of the company, right? You may let's say you may actually disagree with him. That's completely fine, right? You can actually throw away the company and not invest in it, but always start off with understanding the business story from the founder perspective. What is he trying to build? Then you should try to validate that hypothesis. That's the hypothesis that you have. Then you should try to hypothesize or let's say validate the hypothesis based on the next points, right? Understand the scale of the market. This is where research comes into picture. You have to do some Googling. You have to do, let's say, some, you have to read reports on that sector, in that sector. And of course, people who have done sector analysis with me before, they know like what are the kind of different sources that they can actually refer to. Understand the scale of the market. How big is the market? How fast is it growing, right? Third, understand the unit economics. I'll have another slide on unit economics. I'll just explain that later. Advantage over competition. Is it a winner take all market, right? Some markets are designed to be winner take all market. Otherwise they cannot sustain, right? Food delivery market, unless one winner emerges, no one can make money. Ride hailing market, unless one winner emerges, no one can make money. So it has to be winner take all market. Otherwise they will keep fighting over prices, right? So you have to understand this, that what are the advantages over competition? Is there a clear advantage that one company has? And if, let's say, only one winner has to remain, is that company going to be the only winner? All right. Then value chain analysis, I'll teach you about that as well. Then DCF can work in the future. DCF is discounted cash flow. Don't fret over it. It's a complicated finance framework, which is used to, let's say, calculate the valuation of a company. Don't fret over it. Even if you don't do that, that will work out fine. My students from before, they can do that and do, let's say, projections, take earning projections 3 years, 4 years later when the company becomes profitable, right? Awesome. Arvind, how much time do we have?
We don't have any time, to be very honest. We are already like running a lot late. So we'll either have to shift on to some other Zoom link if we were to proceed with the next anytime.
Oh, okay. When does the meeting stop?
So meeting will stop at the meeting will stop in 3 minutes, like 6:40.
No, so the issue is that this link will expire actually.
Yeah.
There's another meeting, there's another class, bootcamp class that's scheduled at this link, and that cannot happen, let's say, if we continue in this link, right? Okay. What do we do then? How many people are there? 148 people are there. Are you guys comfortable in shifting to some other link? If you want to continue, we can share one more link in all the groups. And if you are interested to, let's say, continue learning, then please join on that link. All right. Arvind, are you going to share that link?
Yeah. So I think you can carry on for the 2 minutes. I'll just quickly make a new link and we'll shift on to the Lakshmi sir, आपकी नहीं है, दूसरी class है. Yeah. So we'll move on to the next one.
नहीं ठीक है, दूसरे पे शिफ्ट कर जाते हैं. Let's start at 6:40. ठीक है, 2-3 मिनट हैं. आप यहाँ से लीव कर सकते हैं and then you can join.
नहीं, मैं यहीं पे शेयर कर देता हूँ. Firstly, let me share the link over here so they can directly just move into the next one, and we can, yeah.
Awesome. If you want to go to the washroom and come back in 2 minutes, you can also do that. We will share all the recordings as well.
So I'm sharing the link, and I'll also leave from here and just start that meeting, right?
All right. You can close this meeting. That's okay. You can share here, and then you can also share on the group.
Yeah, I'll be sharing on both the platforms and like ending over there. Yeah, I've just shared. So you guys can all jump into the next link, and we'll have a detailed discussion rather than a time-bound discussion, right? Yeah.
Awesome. Cool. So we discussed that a couple of factors we have to see for analyzing new age companies. One of the important factors is analyzing the unit economics of a company, right? And that becomes an important checklist point. If the unit economics of a business does not work, it does not make any sense to invest in that company at the IPO stage, at the pre-IPO stage, at the post-IPO stage. It does not make any sense, right? what is unit economics actually? Unit economics is, if let's say whatever service you are selling, what is the finance, or what is the breakage of per unit revenue that you are earning? What is the structure of the per unit revenue that you are earning, right? Let's take an example of Zomato. Zomato is in the business of food delivery, online food delivery, right? Their average order value, I'll give a definition of that as well. Average order value ranges between 400 to 450, if I'm not wrong. I think 400 to 450 is the average order value on Zomato. So when people order on Zomato, on an average, the order size is around 400 to 450, right? Zomato earns round about 80 to 90 rupees on that order. 80 to 90 rupees comes to them from that 400 to 450 order, right? And of course, out of that 80, 90, they have to do spending. There are some costs involved. So what is the breakage of that cost also, right? Average order value is kitne khane ka, average on average, what is the order size of one food order? And then what is the commission that Zomato is earning out of that? You should always keep in mind that the commission that Zomato is earning is actually the top line for revenue for Zomato. Jitne ka order hua, that is not the top line for Zomato. Top line or revenue for Zomato is the commission that they get as a cut of the overall order. Zomato cannot say 400 rupees is my order or 400 rupees is my revenue. 80 rupees is the revenue, right? So we have to start off with that and try to understand inke baad, what is the operational cost that they have to incur in each order. In each order, what is the operational cost that they have to incur, right? So if we study 2020, fiscal 2020 unit economics, you can see on the left hand side, 43.6 plus 15.3. These two values, 43.6 and 15.3, if you add them, you will get around 58.9. 58.9 was the revenue that they were making per order. 58.9 was the commission that they were making per order, right? If you're not able to see the text below, I think font size is very small. It's written commission and other charges, which they charge from the restaurant side, commission and other charges, and customer delivery charge, which they directly charge from the customer side. Right? So 43.6 plus 15.3 becomes 58.9. That's the top line. That's the revenue for Zomato per order, right? Now, what are the costs that they're incurring? Whatever value you see in brackets, always remember in finance, bracket denotes negative. All the costs are always shown in brackets. Bracket denotes negative, all right? So 52 rupees is what they are spending on the delivery, that is the money that is paid to the delivery guy to bring the food from the restaurant to your home, all right? So they are collecting 15.3 as a delivery charge, but they are paying 52 rupees to the delivery guy, right? 21.7 is the discount that Zomato gave to the customer, which of course they have to pay the restaurant after the order is delivered. They have to settle it with the restaurant. They have passed on the discount from their own side. So that's also cost to Zomato, right? And in India, if you don't give if you don't give discounts, anyway, you don't get growth. So discounts are a part and parcel of startups in India, right? 15.7 is the other variable cost, and that's also attached within that order, right? So that might be like overheads that are there, right? Might be delivery ke time hi kuch aur, let's say, kharcha ho raha hai, or you're offering like some other extra discount, etc., etc. So all the other variable costs will come here, right? If you're doing like packaging from your own side, whatever. So all these costs will get added here, right? So if you do a summation of all this, 58.9 is the revenue, minus 52, minus 21, minus 15.7. The last figure that you see, the red figure that you see, is 30.5. That is the contribution margin, contribution profit / loss. So always remember this term, contribution margin. Whenever you're studying any startup, whenever you're studying any new age tech company, and if you're, let's say, analyzing, and if you're having a discussion with your friends, with your family on investing in any company, always ask this very important question: what is the contribution margin per order? Contribution margin per transaction per order, right? So that was in loss. So Zomato was in loss per unit. And by the way, you can see it from the figure as well. We have not added marketing cost. We have not added employee cost. We have not added any fixed cost that is incurred by the company. That's also huge, right? This is only the cost which is involved to make the order a success. So as in just to facilitate that order, right? Only the cost attached with that particular order. So if let's say if you facilitate one order and Zomato is incurring a loss on that, then how can the company become profitable? It cannot, right? So that's where when they decided to IPO last year, they actually focused heavily on the unit economics. Now you can see in the 9-month fiscal of 2020, April to December of 2020, this was March 2019 to March 2020. So this should be fiscal 2019. So this is fiscal 2021, right? So you can see in the 9 months from April to December 2020, the unit economics improved. What happened was commission and other charges improved. So from 43.6, it went to 62.8, right? That primarily happened because of two reasons. One was the average order value on Zomato started increasing during COVID. Average order value started increasing, right? Pre-COVID, whatever food people were ordering, mostly people were ordering snacks, etc. Right? During COVID, people also started like ordering complete full-fledged meals, etc. Right? So average order value also increased. Agar average order value will increase, let's say from 400 to 600, automatically 20% of that will become higher. Or let's say whatever 15% that they are charging. So commissions that were coming to Zomato per order started increasing, right? One, because of average order value. Second, I think they also increased commission percentage. They also increased commission percentage, but that was not like a great jump. I think 15-16% that became 17-18%, right? So that 43.6 became 62.8. Plus, they also started incurring more delivery charges. Initially, they were charging only 15.3, that became 26.8, right? So in total, the revenue for Zomato per order became 62 plus 26 is 88 and 89.6. So close to 90. 90 rupees per order is the revenue that Zomato made per order. All right. Now, what about the costs? They controlled the delivery cost. They also, if you remember, in I think April, May, they actually fired a lot of people. Also fired a lot of people in the delivery side. On the delivery side also. Mostly in, let's say, expensive, mostly in tier 1 cities, because tier 1 cities, the salaries that are given to delivery boys is actually higher, right? They try to make things more efficient there. So the delivery cost also decreased. Right? 52 say 44.6 it came, right? Discounts also they cut down on that. Other variable costs also decreased, right? And then finally, in the 9 months from April to December, their unit economics looked positive. So they started making 20 rupees contribution margin per order. Still, they're not profitable as a company, but for each order that is getting executed, they are at least getting 20 rupees into the company. They're getting 20 rupees into the company, right? Now you have to look at other costs also, of course, which is marketing cost, fixed cost, technology cost, all that cost is there. But the first and the foremost step and the big step for any, let's say, scaled startup in India is whenever they're doing IPO, we should look at the unit economics. Agar unit economics ही negative hai, then don't even look further. So that's the first learning that you've got. Don't even look at companies with the unit economics negative. All right. So only focus on companies where unit economics are positive, right? Now, of course, Zomato is not profitable as a company. Now, why are they not profitable? Because a major chunk of their spending goes into marketing. So they spend around 250 rupees. To acquire one new customer. Right? On the marketing side, their CAC, paid CAC, customer acquisition cost is 250 rupees. Right? Now, if they're earning only 22 rupees per order and their paid CAC is 250 rupees, that means Zomato will try very, very hard to get every customer to give at least 10 orders to break even. Did you understand this? So Zomato will try very, very hard to grow their repeat rate. And because they're in the food business, normally the repeat rates are high only. So the repeat rates, I'm not so sure what is the current repeat rate, but it used to be like 6, 7 when I had a talk with their executives before, like 3 to 4 years ago. That's like very old story. I'm not so sure, right? But they have to like make the customer repeat at least 10 to 11 times to become profitable in the current unit economic scenario. Right? So of course, that's where Zomato Pro comes into picture, Zomato Gold comes into picture. They use a lot of, let's say, data personalization also to get you to repeat more and more, right? So all these things are there. Arvind, I'm getting some disturbance.
Yep, I've just unmuted them. Yep.
Awesome. So the first step always when you look at, let's say, new age companies is unit economics should be positive. Post that, you can do other analysis. If unit economics are negative, don't even look at that. All right?
Yeah, I'll change the setting. Just give me a minute. I'll change the setting to like you can't unmute yourself. Then we can proceed, right?
Awesome.
Yeah, Akshay, you can mute yourself. Unmute yourself, sorry.
Awesome. Okay. Cool. You can see contribution margin as a percentage of gross order value. That started increasing for Zomato. This data of Zomato is of Zomato. People were asking where can we get these details? In the DRHP. In the DRHP, it is mentioned. Of course, you will be investing in IPO time, right? So IPO time, or let's say after IPO. In DRHP, they have given a detailed analysis of unit economics of the company. If the company's unit economics does not make sense, don't even think about it. Don't even think about it, right? If it is positive, that does not guarantee that you invest karna hai. There are other factors that you have to look at. I'm coming to that, right? Awesome. So the next step is, let's say if the unit economics are positive. Unit economics are positive. How do we make sure that the company becomes extremely profitable in the future? Right? That is where the concept of value chain analysis comes into play. Value chain analysis comes into play. Right? Now I've given a very simple example here. How does value chain analysis work? Right? Let's say we are talking about the ice cream industry, ice cream sector, right? Ice cream market, right? What are the different kind of players that are involved in the ice cream sector, in the ice cream industry, right? There's a dairy farmer, jo ki doodh leke aata hai, right? Dairy farmer gives milk, right? And of course, these are like US. There's a US example that I've taken. So prices are in dollars, but you will get a good picture of what I'm trying to tell you, right? So dairy farmer earns 15% margin, right? Sugar importer makes 10% margin, right? Additive producer, what is additive producer? The vanilla flavor, the butterscotch flavor, the chemicals that goes into manufacturing the ice cream. The manufacturer of that, the producer of that is the additive producer. He's making 30% margin, right? Then of course there's the ice cream manufacturer which mixes all this, which has machines, etc. He makes 25% margin. Then there's a food service distributor which is 23% margin. And then there's finally the grocer who sells you the ice cream, which is making 7% margin. All these margins are getting added, right? Similarly, in any industry, there are different kind of players. Whenever they add something to the entire value chain, they get some margin, right? Now here you have to understand, in every value chain there are one or two key differentiating value providers. What does that mean? In the ice cream value chain, who do you feel is the key differentiator? Additive, right? Additive. Can the dairy farmer be replaced by any other dairy farmer? Yes, it can be. Can the sugar importer be replaced by any other sugar importer? Yes, sugar is a commodity. Milk is a commodity, right? Distributor can also be replaced. That's where the highest margins always go to the key differentiating value provider. Right? Let's come to the restaurant business again. Zomato example again. In the restaurant market chain or on the restaurant value chain, what are the different kind of value steps that are there? And I've also explained Zomato in detail when the IPO came. There's a specific video also. Arvind, you share that video in the
I'll share that in the community.
Community पे share कर देना. वो पूरी 1 घंटे की video है जिसमें मैंने have explained Zomato in detail, right, to all the bootcamp students. All right, we can share that. So in the restaurant value chain, what are the different kind of steps that are involved? Let's maybe talk about it, right? First is the grocery provider, right? जिससे सामान आता है, raw material of food comes, right? Grocery provider, that's like the first step. Second is the brand, right? Brand means who takes groceries, hires cooks, chefs, etc., and then makes food out of it, gives taste to it, makes food out of it, right? That's the brand, food brand, right? Third can be, let's say, the real estate, ki jahan pe whatever, let's say the kitchen is situated, etc. There will be some real estate provider also, or let's say it's an individual. There are individual players taking away margins or taking away cost from this entire value chain, right? That's the real estate. That's which is where it is situated. The kitchen is situated, right? The fourth will be marketing. Whoever is doing the marketing, whoever is bringing in the orders, or whoever is bringing the customers, right? Fifth will be delivery. Whoever is doing the delivery, right? Then sixth will be let's say any finance software that you're using, any, let's say, POS that you're using, any all of these small chota mota SaaS softwares that you're using, right? Seventh might be whoever is giving working capital to the restaurant, right? Whatever is giving working capital to the restaurant. Now, if you feel that Zomato will limit itself to online food delivery, we are actually fooling ourselves, right? एक तो बहुत बड़ी गलती करते हैं लोग. People do this mistake a lot. People think that whatever we read in articles, in media articles, that all these startups are making losses and all these VCs are fools. So we believe that. Right? Actually, the journalist who is writing the article is a fool because he's not understanding anything about the tech ecosystem, right? VCs who have like studied the industry really, really well, and they have billions of dollars deployed. Why will they make a foolish decision without even thinking about it? Right? So they understand that Zomato will not only limit itself to online food delivery, they'll actually enter each step of the value chain. They've already started Hyperpure, which is giving groceries and raw material to restaurant. In fact, packaging material as well. Right? So whatever, let's say, margins that I showed you, this contribution margin does not include the margins that they are earning from Hyperpure. This is only and only online food delivery, but groceries will be added, so this will increase. Second, they have already started their own cloud kitchens, right? So they have already entered the brand game as well. And brand is where the highest margins are there because that's the differentiator. That's the differentiator, right? Domino's earns around 40% margin, I think, 40 to 45% margins on each order. So that's the highest margin play, brand, right? Who's cooking? Because that's the taste differentiator, right? You cannot replace the brand. So they've already entered their own, they're already building their own cloud kitchens, and they're well suited to build their own cloud kitchen and sell it, right? Marketing is anyway done by Zomato because all the customers are anyway on Zomato. Delivery is anyway done by Zomato, right? POS software, they are all anyway selling to restaurants. So they've already started all this like long time back. And working capital loans, they're going to start very, very soon. In 6 months, they're going to start. So in the entire value chain, Zomato will be eating away margins. In the entire value chain, right? In the entire value chain, they'll eat away margins. I'll just give you like small snippet for you to, let's say, get a sense of how big Zomato can be, right? Domino's has 1,300 restaurants. 1,300 restaurants, right? They get like 40-45% margins, right? They have a valuation of 40,000 crores. The last I checked, they have a valuation of 40,000 crores with 1,300 restaurants, right? Zomato has 1.3 lakh restaurants listed on platform, which is 100 times the scale of Domino's, right? Zomato, of course, is loss making right now. It's of course loss making right now, right? But you can imagine what Zomato can do with 1.3 lakh restaurant if they turn profitable. Right? So there's always a story attached with, let's say, with whatever they're building, right? VCs are not fools. They know how to make money, right? So they have 1.3 lakh restaurant. If they figure out the unit economics really, really well, if they understand, and anyway, they have network effects, so there's no competition also coming in, right? Most likely they will have like a merger or an acquisition with Swiggy, right? Once they have that figured, once they enter the value chain deeply, then there's no stopping them, right? So the sweet answer, the short answer, should I invest in Zomato right now? The answer is no, because you should have a thesis, strong thesis, and you should stick to that thesis, right? Whatever I told you is true. There's great potential in Zomato, but as an investor, I'll not enter till the time I see profitability, right? Till the time I see profitability, I'll not enter. After they enter into the profitable zone, I'm going all in, which means I'm a long-term investor in Zomato then. Right? Whatever story I've told you, it's plausible, but it's not a reality right now. But you should understand the story really well. Right? Once it starts happening, then you can get into and then enjoy the ride for the next 10, 15 years, right? Awesome. So I've taken an example of Zomato and showed you how to do this. And the same is true for like any other startup also. Nykaa, very interestingly, showed profitability in their books, right? Net profitability. And that's where I was also very, very bullish on Nykaa, right? Very strong brand. Fashion, beauty industry is one industry where, let's say, you make 30, 35% margins also, right? Very strong community that they've built on, right? So amazing company that they've built. I am very bullish on them. Very, very bullish on Nykaa, right? Awesome. Vicky says, at last we see profitability. Yes, profitability you have to see before investing, right? That does not mean if the company is not profitable, don't study the company. Study the company, take a patience, have patience and look at that company. When it becomes profitable, then you can enter, all right? Awesome. So I'll just give a quick screener walkthrough. Before I go to screener, I'll just maybe walk you through some of the metrics, which I'll actually show you on screener and why are they helpful. First is the efficiency metric. I already showed you the business growth engine. If I have that, I'll just go to that directly. Yeah, so this is the business growth engine. People who did not attend in the morning, this is a very simple growth engine that you should always remember. Capital is given as input to the business. Profits and earnings are the output, right? How do we measure the efficiency of this engine? The efficiency is measured by return on capital employed. Return on capital employed, right? Better the efficiency, better the businesses, better the chances of long-term success are. Right? Better the chances of long-term success are, right? Companies take some of these profits and put back into the business again, and that's where growth happens. That's where growth happens, right? In the bottom equation, I've also explained that PE multiple, PE ratio is basically tells you the perception of the market. EPS is the primary utility or value of that stock. EPS, earning per share, right? If you have to take a long-term bet, if you have to take like a 10 years, 5 years, 10 years bet, only and only focus on EPS. Whether EPS can become 5 times, 10 times, right? Price will definitely move in that direction wherever EPS is moving, right? There's a question coming up. How does ROE differ from ROCE? ROCE is return on capital employed. ROE is return on equity. That's the basic definition. That does not tell you anything. In fact, that confuses you. I may give a longer explanation, but that will eat a lot of time. I'll just tell you 2 facts that you have to remember. All right. It is easier to inflate ROE from the business side. If I have to inflate ROE from my company, I can take a lot of debt, grow with that debt capital and increase ROE, right? That's where ROE is not a true representation. It is not a true representation of the company. It is not a true efficiency metric, right? But there's like one thing that you have to remember. For banking industry and for the industry where raw material is money, right? What are banks kya karte hain? Banks actually buy money and sell money, right? They buy deposits and sell loans, right? So for banks and wherever, let's say in the finance industry, wherever raw material is the money, we will not look at ROCE, we will look at ROE. So for all other industries except banking, we'll look at ROCE, return on capital employed. Only and only for banking, only and only for financial industry, we will look at ROE, right? Short and sweet answer is ROE. It is easier to inflate as a company. I can make ROE as 100 also, 200 also, but that does not mean my company is good, right? So ROE is simpler to, let's say, falsify, all right? Awesome. So let's move to the last page once again. I'll show you the metrics which we are going to look at screener. Okay. Yeah. So ROCE, ROE will look at, that's the efficiency metric. Minimum, you can note it down. Minimum ROCE should be 15%, 1.5. Minimum ROCE should be 15% from a long-term perspective, right? ROE of banks should at least be 12 to 13%. Should at least be 12 to 13%, right? EPS growth is the primary growth metric that you look at. EPS growth is the primary growth metric that you look at, right? Earning per share, we look at growth of this. If that is happening in the past and that will continue in the future, then we are good. The company is good, we can invest in that company, right? Sales and margins expansion. I'll show you how to look at that, right? Sales is the overall top line revenue. Kitna paisa overall aa raha hai company ke andar, that is sales. That has to be growing. Plus, if margin is also expanding, that's an added advantage. But that's not a requirement, right? There are some sectors where margin expansion cannot happen. Margin बढ़ ही नहीं सकता है, right? The only way to grow is sales. ठीक है? तो sales भी देखनी है, margins भी देखनी है. मैं आपको दिखाऊंगा कैसे देखना है screener पे. ठीक है? Then there are a couple of red flags that we can notice. Red flags that we can notice on screener, right? Before that, I'll just take a question of Adil. EPS, earning per share. Never look at the absolute value. Does not make any sense. हमें EPS की growth देखनी है. EPS move कैसे हो रहा है? How is the EPS growing? EPS of 50, EPS of 5 does not tell me anything. EPS of 50 moving to 60 in the next year tells me a lot of things. That earning per share of that company, utility of that company increased by, let's say, 20%. That is telling me a lot of things. EPS of moving from 5 to 6 and moving from 50 to 60, same year, because both of them are growing at 20%. Right? So absolute EPS does not matter. Does not matter. Growth matters. EPS growth matters. All right. Now coming to red flags, there are a couple of rejection criteria, red flags that we can use to remove some companies from our list so that we only get good companies, right? The first is debt to equity. Debt to equity. Now I mentioned in the growth engine figure that I showed that there are two ways to raise capital. One is debt capital, the other is equity capital, right? Problem arises when the company raises too much debt capital, right? Because debt capital gives you a liability. What is that liability, right? आपका मान लीजिए हर साल 100 crores का profit बनता है. Company makes 100 crores of profit every year. They have taken a loan of, let's say, 80 crores. So they have taken a loan of, let's say, 1,000 crores, which through which EMI goes of 80 crores. There's an EMI every year they have to pay of 80 crores, right? And the company is making 100 crores. That's good, right? So they are able to like repay the EMI, right? They can pay the EMI very comfortably. But there can be a scenario where company in any particular year, due to whatever COVID happened, whatever happened, profits may drop to, let's say, 30 crores, right? That's where, and debt comes with a liability, legal liability that you have to pay the EMI. See, equity capital is not asking you, equity investor is not asking you money every year, but debt, it's a legal obligation. You have to pay the EMI, irrespective of, let's say, profits, irrespective of loss. Take money from wherever, right? If you can't pay, they'll actually force you to sell your assets. You'll have to dissolve the company, right? So that's where debt to equity should be in control. Now, there's a logical explanation to how lower debt to equity should be. I cannot go into detail of that. Boot camp में हमने अच्छे से cover भी किया था, कुछ लोगों को याद भी होगा. The summary of that is, the short answer to that is, debt to equity should be less than 1. Should be less than 1. Debt to equity should be less than 1. There's a logical explanation to it. मैं आपको रटवा नहीं रहा हूँ, but मैं बता नहीं सकता अभी logical explanation. ठीक है, time कम है. Debt to equity should be less than 1. Then we are good. Then we are good, right? Less than 1. Do not compare values and do not make your judgment कि यार debt to equity कंपनी की 0.5 है और दूसरे कंपनी की 0.8 है, तो 0.5 वाली अच्छी है. ऐसा नहीं होता है. Less than 1 is the requirement. Less than 1 जितना भी हो, I don't care. So don't take comparisons based on debt to equity कि इसका 0.5 है, इसका 0.8 है. Don't do that comparison, right? It should be less than 1. That's it, right? Pledge shares. Pledge shares is, now first of all I'll cover promoter holding. उसके बाद pledge shares पे आते हैं. Promoter holding is how much holding, how many percentages of the share of the company are owned by the company's owners, by the company's promoters, right? By the people who started the company, or let's say are managing the company, right? So that's promoter holding. Should it be less? Should it be higher? Ideally, it should be higher. Ideally, it should be higher. Even if it is low, it should not be decreasing with time. It should remain stable, right? If promoter holding is decreasing, which means owner is actually selling their own shares, that shows you that the owner does not have confidence in that company, right? That shows you the owner does not have confidence in the company. Ideally, it should be high. I would want it like 60 to 70% of the company is owned by promoters, right? The reason is, if you have more equity, if the owners have more equity, they are more motivated to grow the company, right? But even if it is low, it should remain stable. And the caveat I'm giving you, even if it is low, because a lot of new age tech startups, which will get listed in the next 10 years, they will have low promoter holding. They will have low promoter holding. The reason is they have raised multiple rounds of VC funding. In fact, Series C, Series D के बाद वैसे 20% नहीं बचता है founder के पास. After, let's say, raising 3 or 4 series rounds in VCs, they do not get more than 20%. Anyway, it gets diluted away, right? So it is not like a red flag that we'll actually reject the company on. We will have to see gradually after listing, gradually whether the promoter holding is increasing, it is stable, or it is decreasing. If it is decreasing, then we will not invest in the company, which means the owners are actually selling their own shares, right? Now, linked with that is the pledge shares. Linked with that is the pledge shares. Pledge share means, I'll take up the question first. Can decrease in promoter holding in some scenarios can be ignored? Yes. So whenever, let's say, there's a fresh offer, so you'll have to understand whether promoter holding has decreased either by selling or, let's say, by more dilution, right? So let's say more shares are introduced into the company, right? I was holding 20%, but as a company, board decided to introduce, let's say, more shares into the company so that my shares get diluted away. My shares get diluted away, right? So more money is actually flowing into the company than going to the founder. Founder is not taking out money. So whenever there's a fresh offer, then also fresh public offer, FPO it is called, then also promoter holding will decrease. That is not a sign of worry. That is okay. Money is going to the company for growth. That is okay, right? But wherever, let's say, owner is selling their own shares, that's a sign of worry, right? And I'll also show you where you can get all these notifications, get all this information in Screener. Screener will actually tell you. Okay. Then comes pledge shares. Pledge shares is nothing but, as an owner, whatever shares I hold, I can pledge these shares to take a loan from the bank. हिंदी में एक वर्ड होता है गिरवी रखना. गिरवी रखना, ठीक है? What is it called in English, Arvind? I forgot.
Loaning.
No. So गिरवी रखने को भी इंग्लिश में कुछ बोलते हैं. I forgot.
Mortgage. कोई कहते हैं mortgage.
Similar to that. So similar to that. So let's say if you mortgage your home, collateral, yes. Not
This is the ratio.
collateral, yeah. So you put your home as collateral. If you are not able to pay the loan to the bank will actually take away your home, will actually sell your home to recover the money. Similarly, what happens is, if you have pledged your shares, if you have pledged your shares, right, bank has the right to actually sell these shares also. Now, when do they sell the share? Happens in two scenarios. One, the founder is not able to pay the money to the bank to repay the loan. Second, the value of the collateral comes down. Right? Think about this. Bank gave you loan of 1 crore with a collateral of, let's say, 1.2 crore of shares. They gave you a loan of 1 crore with a collateral of 1.2 crore of shares. Because share price keeps fluctuating, what happens if the share price falls and the value of collateral now only is 50 lakhs? Will bank be in worry? Yes, they will be. Right? So banks will actually have a right to sell the shares whenever the share price is also falling. In fact, that creates a negative effect in the share market. They also start selling, and anyway the price is falling, and then the company gets bust. Right? So always stay away from companies where pledging is there. Right? Pledging should be nil. Pledging should be nil. All right. Then there are two more important factors, which is debtor days and inventory days. Mostly important in consumer-based distribution companies, FMCG companies, etc. B2B companies maybe kuch mein it is valid. Debtor days is how much time does it take? How many days does it take to recover money from the buyers? I told you about Parlay, right? So when Parlay goes through, let's say, selling biscuits through their distributors, through their shopkeepers, etc., they do not get money immediately. Their money gets stuck. So how many days on an average it takes to get back the money? Because think about this, in the growth engine, you have generated profits, but you are not getting cash. How can you reinvest that cash? How can you get more inventory to sell? Right? So ideally, you would want cash to come as soon as possible to you. In fact, you would want the cash to come in advance. Right? There are companies where cash gets generated in advance. For example, let's say Netflix. Right? You pay for, let's say, 1 year subscription, and they've not even like delivered you like 1 year of value services, and they've already taken away the money. So there are a lot of services where, let's say, you pay money in advance. All right. So debtor days is the number of days, average days it takes to recover the money from the market. All right. Inventory days is how many days it takes to sell the inventory on an average. Whatever inventory you procure or let's say you manufacture, what is the churn? How fast are you able to sell that inventory? Logically speaking, both these two should be lower. Jitne kam honge utna acha hai, right? The faster it is for me to, let's say, sell the inventory, and the faster it is for me to, let's say, recover the money from the market, the better off I will be, because I can use that money that I've recovered to, let's say, grow the company even further. Right? So we'll also check these two things in the screener. So let me just actually stop sharing, and then I'll move you to screener quickly. Arvind, can you see?
Yep, it's visible.
Okay. Cool. So this is screener.in, right? Arvind, you can share the link also in the chat.
I'll do that post class. I'll share the link post class, post this class, right?
Awesome. So first of all, I would maybe teach you like how to add stocks into watch list, right? It's a very important feature of screener.in. Screener.in we'll be using for fundamental analysis, right? To get like important business metrics and to make a decision whether to invest in the company or not. No trading decisions should be made through screener. All right. Keep these two very, very separate. If you're a trader, screener.in will not help you out. All right. Amazing. So First of all, let me just tell you how to add a company into watch list, right? So let's say we are understanding Zomato. So I'll just write Zomato here and then open up the Zomato company page. Zomato company page, right? And from here, from the blue button that you are able to see, you have to follow. What happens if you follow? Whenever you open Screener, or let's say whenever you open Feed, you get important information of Zomato here in the watch list updates, right? So whichever company you are interested in, always as a first step, add that to the watch list, right? After adding to the watch list, whatever developments are happening in that company, you will get notified through your watch list, right? What are these developments? Whenever the owner is selling shares, you will get a development, right? Wherever, let's say there's a quarterly result, you will get an update, right? Wherever, let's say there's a credit report about the company being published, you will get an update. Whatever update is happening about the business, Screener did a very fantastic job. They pulled out everything and they are showing you here. So this is the feed for the companies that you are interested in, right? You can see some of the companies that I am following: Lalpath, IndiaMart, Aptus Value, Moltech. Biswadeep sir will be really, really happy. I'm following Moltech, right? Awesome. So great. So that's the first feature that you have to improve, right? Second is in the home itself. In the home itself, there are interesting, let's say, on the right hand side, you can see there are two interesting things that are mentioned here, which is new quarterly results. If you click on new quarterly results, they give you a summary. They give you a summary of the quarterly results which have come up in the last 3 days, last 1 week, right? So you can see all these quarterly results coming up. Is there a next page? No, there's no. So in the last 3 days, they'll show you. If the season of quarterly results is going on, you'll see this page filled with quarterly results, right? This becomes an easy, or let's say very comfortable hunting place for you to hunt good companies. Ideally, whenever, let's say there's a result season going on, you should come to Screener, open new quarterly results and analyze like this. I'll tell you my way of analysis. The first thing that you should always look is year-on-year EPS growth. Year-on-year EPS growth. ठीक है, स्क्रॉल करते जाओ और ईयर ऑन ईयर ईपीएस ग्रोथ देखते जाओ सारी कंपनीज की. You only look at like one metric, year on year EPS growth. That's it. In this page, that's it, right? If there is tremendous EPS growth happening, like above 20%, above 25%, keep 20% as your bar. Keep 20% EPS growth as your bar, right? And I'm not saying quarterly. Don't look at June 2021 compared to September 2020. Don't look at that. September 2021 compared to September 2020. Same quarter, year on year. All right, always compare that. तो अगर यहाँ पे growth है, बहुत amazing growth है, and they've also mentioned a number here. If that number is about 20%, that's an interesting company. If it's an interesting company, let's say this is an interesting company, then I will open link in new tab, which means the company will open up. The company page will open up, then I'll go into detail, right? So that becomes an easy hunting place for me to look for interesting companies, right? The first step always is EPS growth is happening, which means something interesting is happening in that company. The company is able to grow their earnings, right? Amazing. One step that you can like add here is if let's say EPS growth is very high, but it's a very small company, make a rule for yourself. Do you want to invest in very small companies or not? So I have a rule. I don't invest in companies with market cap of less than 1,000 crores. Less than 1,000 crores, I don't even look at them because it's a wastage of time, right? Don't even look at them. You can also make a rule for yourself. You can decide 500 crores, 1,000 crores, or 5,000 crores. And if EPS growth is happening, but the market cap rule is not fulfilling, it's not fulfilling that, then don't even look at that, right? Awesome. Uske baad, this is an interesting thing. Then let's go back to feed again. So feed में तो आपको दो चीजें मिल गई. There are two things that you get. One is the watch list. Then there's the new quarterly results, right? Then let's go to a company page. Let's go to the company page. Let's open. Can you guys recommend me a company?
Any company which you'd like to analyze. Like this is a golden opportunity. People should post companies. So Sayena said IEX. Let's see IEX.
Let's see IEX. Okay. Awesome. IEX. Right? Awesome. So what are the things that we have to look at? So first is Screener does a very good job to give you a summary also of the business. So if you're opening up this page for the first time and you don't know anything about the company, more or less for all the companies, you'll get good information here in the about section. This is like a subjective information that you'll get. Ki company karti kya hai? What is the business all about, right? Also, you'll get key points. So if you read more, you can actually read more about the key strengths, key weaknesses of the company. Now, mind you, this content is not written by Screener team. It is not even vetted by Screener team. It is a crowdsourced content. So I, as a user, can also edit this. I, as a user, can also edit this, right? So this is user given content. Don't believe it blindly. Agar अच्छा लग रहा है यहाँ पे, if you like the information you have provided, most likely this is provided or this is taken from the annual report. So if you like the information before investing, validate that information again from the annual report. All right. More or less 99% of the times the information will be correct. All right. Awesome. Because they just copy paste text from there. All right. So this is the subjective side of things. On the left hand side, these are the important financial ratios that we have to look at. Important financial ratios that we have to look at, right? You can add ratios to this table from here. You can add ratios to this table from here, and you can also delete some of these ratios from here, right? So because I've already logged in, you are seeing some of the ratios that I look at, right? So you can see ROCE here. If ROCE is not visible to you when you first go to Screener, you have to add, you have to like write ROCE here and click on return on capital employed, and it will get added. It got added again. So ROCE for 59.7, ROCE 59.7. Right? That's the ROCE. What is the limit that we had? The limit that we had was 20% or 15-20%, right? So it is above that. So definitely a thumbs up from our side that ROCE of this company is good, right? Second is we then have to look at EPS growth, right? So let's go down. Let's go now. Here you will see an interesting chart. Now this chart is a price chart. Because we are doing long-term investing, I don't care about the price. Right? Very surprisingly, right? But let's first focus on the utility, whether utility is increasing or not. What is the utility in that stock? EPS. So what you have to do is you have to click on P ratio. Have to click on P ratio. P ratio table shows you 2-3 things, right? One is the price to earning. One is the price to earning. Price to earning is this, this blue line, dark blue line that you are seeing. That is price to earning, PE, right? The other is median PE. Forget about that. TTM EPS. Trailing 12 months EPS, which is what I'm most interested in. So I'll disable price to earning. I don't care about this. I'll disable this. Right? I only care about TTM EPS. Normally, if you see a growth here, if you see growth in EPS, normally if you see exponential growth happening in TTM EPS, it's a very, very good sign. It's a very, very good sign. All right. EPS should be growing. EPS should be growing. In all of the companies that we filtered in the bootcamp, all of them had increasing EPS. So that becomes one of your essential criteria to look at, right? Once you have validated this, first you should look at graph to get an overall sense of the long term and select 5 years here. Don't look at like 1 month, 3 months. Select 5 years here. The EPS of the company is growing. Then go down and look at the quarterly results and the P&L statement. In the quarterly results and the P&L statement, you're getting numbers also of EPS. You're getting numbers also of EPS, right? So 0.47, 0.42, 0.44, and it goes up to 0.87. This is the quarterly EPS. And then in the P&L statement, you get annual EPS also. 0.23, it has grown to 2.96. Right? 2.96. Awesome. So you get numbers of EPS growth also here, right? That's EPS growth for you. Then you can see some of the red flags. Some of the red flags. No, before red flags, you also have to see sales growth, right? So sales growth you can see from here. I'll show you. So you can see compounded sales growth here. Compounded sales growth here, right? Ideally, if a compounded sales growth of last 3 years, 5 years is more than 15%, and last TTM is trailing 12 months, last 12 months is also like 15% more than that, then it's a no-brainer. Get into that company. It's a no-brainer, right? If it is for, let's say 3 years, it is less, but last 12 months, it has really picked up. It might have happened that in the last 12 months, something has changed in the company. Or let's say the critical mass which was required to like grow forever from now on, the company is already reached there. So you have to understand, a lot of businesses are structured like that, that for the first 5 years they don't grow, but after the 5th year something happens and then they keep on growing like forever, right? So there's a critical mass to be reached in a lot of sectors, right? So you also have to consider that. So that's sales growth. Margins you can see from here, which is OPM. OPM is nothing but operating profit margin percentage, right? So IEX is anyway, if you understand their business, they're a platform business. They don't incur a lot of costs. They have very, very high margins. They have margins of 80, 86%, right? Which also means they cannot grow by taking the margin growth route. Margin is already at 80%, right? So they have to keep on growing their sales in order to grow their profits. Margin is already 80%. 80% ko 100% thodi kar lenge. They cannot do that, right? So they have to continue growing their sales, right? So that's interesting stuff from here. Then go above, then we look at red flags, right? Red flags. Let's enter debt to equity. So debt to equity you will see as 0.02. I told you it should be less than 1. It is like way below 1 and it's close to 0. It's a very good sign, right? Then pledge percentage is already here. Pledge percentage is 0%. 0%. Change in promoter holding 0%. Also, you can see promoter holding is 0 because they are not a owner-led company. They are a board-driven company. The company has appointed a board. They get salaries, and that's how they drive. It can be a positive. It can be a negative also. For some companies, it works. For some companies, it doesn't. Right? I'll tell you, HDFC Bank also doesn't have a lot of promoter holding. I think their promoter holding is like close to 1 or 2%. In fact, even for ITC, right? So these are like very well-run board-driven companies, not owner-driven companies, and they've been doing really well. So there's no like rule that I've formed कि आप promoter holding अगर बहुत ही कम हो तो नहीं invest करना है. Nothing like that. You should, for companies which have promoter holding and that's decreasing, that becomes a red flag. For IEX, there's no red flag, right? Then we go down. This is EPS. Also, you can see some of the pros and cons from here, right? Interesting pros and cons you can see. Remember, we did not look at PE, right? We did not look at PE because one of the lessons that we learned today was PE is the perception. If you're taking the long-term bet, you cannot take a bet on perception. You cannot say that perception will change in 10 years. You can definitely say that the company will start making 10 times more profits in 10 years. Right? You can definitely say that. You can definitely say that the earnings will increase, right? But you can't say PE will increase, right? So then comes ratios. So ratios is, you can see like interesting ratios here, debtor days and inventory days. Now, because IEX is a platform, it does not make any sense to look at debtor days and inventory days. I told you it makes sense to look at from a consumer standpoint, consumer industry, right? So let's open so let's open ITC. Okay. So if you go back, if you go down and look at ratios here, so you can see that the debtor days of ROC, debtor days of ITC have almost been stable, right? So it started off 2018, 17, it's close to 19, 20 only. Right? It is only like 1 year where it increased a lot, but they have stabilized at 19, 20, right? Inventory days is how many days it takes to actually clear off the inventory. The lower it is, the better it is, right? So it has been decreasing also. It has been decreasing. So normally it was like 266, 250. In the last 3-4 years, it has been in the range of 170 days to 190 days. All right. So good signs, right? Also, ROC is mentioned here for all these particular years. ROC of ITC used to be very, very high. Now it has decreased. Also because the FMCG industry or the FMCG sector does not offer a lot of ROC to ITC. Right? The cigarette industry, the cigarette sector, the cigarette domain is highly profitable. It's a very well-run machine, but FMCG does not give so much profits, right? Awesome. If you see the graph here also, so you can see fluctuations happening here. Right? You can see fluctuations happening. It went up and then it went down, then started up going up. Not a lot of stable growth. So जैसे stable growth IEX में दिख रही थी, it's almost like a straight line, right? I'll show you some of the multi-bagger examples which have scaled like that, right? I'll give you an example of, let's say, Page Industries. Page Industries is the manufacturer, not the manufacturer, the distributor of jockey in India. So let me just actually show you the long-term graph. See from here what happened. And this is earning. This is not like price. This is earning. You can see from 2008, earning of 21.36. After that, it's almost like an exponential curve. It's almost like an exponential curve. Right? And people say it's very hard to trace or hard to track or hard to find multi-baggers. It's so easy. Right? The company is growing their earnings. Sooner or later, the market will discover it. Sooner or later, the market will discover it. Sooner or later, the perception will also change because the value itself has increased. Who can deny that? That's a hard fact. That's hard truth. Companies making that much profit, and that's growing every year. And who can stop the company, right? So you'll see examples like this. There are other examples also. You can see like Bajaj Finance. You can see, let's say, Eicher Motors. You'll normally see trend like this, right? So that is the whole aim for us to when we are doing long-term investing. How do we find companies where earnings can keep on growing for the next year, right? Then we come down. The last section in the company page is also very interesting, which is these 3-4 sections which are mentioned here. I'll start from the left. Announcements done by the company. This is the same announcements that comes to your feed also. This is specific to this company. Okay, so whatever announcements are made, whatever is changing in the company, these are this, right? Then there are annual reports. Annual reports are the detailed document that you get every year, which contains financial data, which contains, let's say, the company's view on how they're doing business, how they're growing, etc. Right? One interesting thing is credit ratings, right? Now, for free members of Screener, you do not get access to credit rating, but if you're a paid member, you get credit rating update also. If you open this, you will read the report given by the credit agency. Credit agency is CRISIL, or let's say there are one or two more also. ICRA is also there. They publish a report every year on how strong the company's financials are, right? When either they upgrade or they downgrade or they give the same rating, right? So they Page Industries has been given a rating of AA, which is stable, and it is reaffirmed. It is not upgraded, it's not downgraded. Stable. So the company's financials seem to be strong, right? You can also read the rationale. This is like a short summary, short subjective summary ki company mein chal kya raha hai, what is happening in the company, whether the company is growing, what are the strengths, what are the weaknesses, right? So this is also very interesting information which you can get in just, let's say, if you have to like read, if you have 10-15 minutes, you can read this summary and then be done with the company analysis, all right? Liquidity position is strong, relative sensitive, and they'll also tell you the weaknesses also. All right, awesome. And then there is Concord transcripts. Now, Concord transcripts are companies management talking about the annual reports or the quarterly reports. Okay, so November 21, whatever con call came, this is, by the way, free. This you can access even if you don't have membership. Right? So this is a document of companies management talking. So this moderator said this, then VS Ganesh, who's the CFO. Right? I don't know. So he actually gave you this. So you can actually listen to this, or sorry, read this, or also listen to this on YouTube. YouTube, there's a channel called Trendline, which also publishes videos or audio recordings of con calls. So you don't have, if you don't have time to like read everything, you can also listen on YouTube. Right? We can also share that link as well. Right? So let's go back to the company page again. Now this is about the company page. The last thing that I want to teach you about Screener is the screens, which is the primary tool, or let's say primary USP of Screener, right? You can actually write logic, you can write a query, and based on that query, based on the matrix, whatever matrix you have fed, they will actually show you whatever companies are satisfying that metric, right? So let us just create a new screen. And by the way, you can also see some screens here. I'll teach you how to create a screen, right? let's just say, and this is very, very simple to write. When I start writing, you can actually understand how do you actually create a query here? How do you create a search query here, right? So let's say I want to limit my search to only companies with market cap of more than 1,000 crores, right? So let's say I'll start writing market cap. I write market capitalization, I push enter. On the right hand side, I will also see the definition of it according to screener. Market capitalization of the company at current market price, value is in rupees crores, right? So I'll push greater than sign, market capitalization greater than, let's say, 1,000. That's like the first statement that I've given to the query, right? Second statement has to be written after and. So this is like a simple logic. If you've done coding, if you've done development, you will understand this, right? Even if you've not done coding, this is very simple. So like one statement comes, and after that, and comes, right? Another logic will start after that, right? Then you have to see ROCE. So return on capital employed. You can also see the definition here. Value is in percentage. It has to be more than 20, let's say. And EPS of, let's say, latest quarter. EPS of latest quarter has to be more than 1.2 times of EPS of preceding year quarter. Did you guys understand this? EPS of latest quarter, which means EPS of, let's say, quarter 2 of 2021 should be more than 1.2 times of EPS preceding year quarter, same quarter of preceding year, which is quarter 2 of 2020, right? And why have I put 1.2? Because of 20% growth I'm seeking. 20% growth I'm seeking. 1.2 into EPS of preceding year quarter, right? And debt to equity should be less than 1. Very simple to understand. And pledged percentage should be 0, right? Yeah, that's it. So let's write this logic and let's see what are the results we get. Run this query. Very simple. And screener will actually use this logic to give me a list of companies. So you can see 121 results are found, right? You can actually, you'll get a list of these companies. Whatever columns you are seeing here, you can also edit this. You can also edit this. How can you edit this? You can edit this from the right hand side, right? Whatever information you require about these companies, you can edit this column also. If you edit this column, let's say I want to see the, let's say, sales growth of 5 years. I'll add sales growth 5 years in the metrics and I'll save columns. And for the same set of companies that were given as results, I will also see sales growth 5 years. Sales growth 5 years. All right. So you can edit these columns as well, right? People who have premium membership in Screener, they can also export. But you need not worry if you're not taken paid membership. You can also simply copy paste this into an Excel. Select this text, Control C, Control V into any Excel that you want. Right? Let me just go to Excel and so all the text comes here. So whatever analysis if you want to do in Excel, you need not export. So आप copy paste करेंगे, then also you get. All right. So you need not spend like money on membership, right? Okay. And you can keep on basically changing the query also. One good starting point will be, if you have to create your own query, go to screens, open up any screen which is already made, any query which is already written. For example, let's say highest year-on-year quarterly profit growth. Let me open up this screen, right? So here some 1, 2, 2, 6 results are there. I'll go down and the query is already written, but it is editable query. So I can change these values and I can add more values also. So that can be a good starting point if you're a beginner in Screener. If you're a beginner in Screener, that will be a good starting point. Start with the existing created screen. Also, I will also share the queries that I use in Screener. So that can be shared. I'll share that in the community. I'll also share. You can just copy paste that, put that in Screener and run this query, right? If you run this query, you'll get a list like this. And then you can do the same analysis that I did, that I showed you how to do that analysis on the company page. If you click on this company, the company page will open up and the same analysis that you've done before will start. All right. Awesome. Great. So this is good. I am done with my screener query. I'm still on screener. If you have any queries, you can let me know in the chat. I'll just take that.
Yeah. So firstly, I hope that things are clear to everyone, right? And I'll be just quickly picking up queries from the chat, Akshay. Then we can maybe answer them one by one, right?
Yeah.
Yeah. So I'll start from the top, from where the names of the stocks were coming in.
Let's
So,
keep a hard break at 8 p.m. Let's
Yeah.
keep a hard break at 8
Yeah.
p.m. We have 6 minutes.
Sure. Let's keep a hard break at 8 p.m. So all the relevant questions, I'll pick that up. So firstly, Sayan is asking if the price is more than the book value, PB is high, is there a sign of worry?
What is book value? Book value is the value that the number that you get when you sell all the assets of the company and you pay off all the liabilities. So asset value minus liability value is the book value, right? Essentially what you are saying is you are आप बिजनेस को रद्दी में बेच रहे हैं, कबाड़े में बेच रहे हैं, right? आप कबाड़ी में बेच दिया. But business is much more than its assets and liabilities. What is the go figure out the book value of Zomato? What is the book value of Zomato? Does Zomato have any asset? No, they don't have any asset, right? They might not have any liability also. So the book value might be like very close to zero, right? So the book value might be, let's say, the office that they are sitting in, right? So don't go behind like a very conventional matrix that used to make sense like 40, 50 years back, right? Book value does not make any sense, except banking, except banking, right? Banking it does make sense to look at book value because book value denotes the size of your loan book, the bank's loan book. What is the asset to a bank? The asset to the bank is the loan book that they've created because that gives them money. That gives them money. So HDFC Bank might have assets of 1 lakh crore. That means they have a loan book of 1 lakh crore. They've given extended loans of 1 lakh crore, right? Yep. So there it might make sense to look at price to book value. That's what you're saying, price to book value. But even then, from a long-term standpoint, as we don't see price to earning in any other company, we don't see price to book value in banks. So long-term perspective, only and only look at EPS growth. You can look at book value growth. How quickly are they ramping up their loan book? You can look at book value growth, but price to book value does not make any sense.
Yeah. Awesome. So next, there's a generic question: shall we use a paid version of Screener, or can we like easily?
So, no, so don't just go away. Don't just go after this class and like pay 5,000 rupees to Screener, because it's 5,000 rupees, I think, membership is there. You can get started with the free version. Mostly you'll get all the benefits in the free version as well.
So at initial levels, you don't require any support from the subscribe like paid Screener version, right?
वो सिर्फ आपको credit reports एक extra दे रहा है, उसके अलावा कुछ नहीं मिल रहा.
Yeah. And how do you save the screen you created by giving a name?
Acha, so I didn't show that. There was an option to save screen also. You can save that. That will be saved in your profile. So let me just write a very simple query: ROC of more than 20%. So you can see like there are 5,000 companies listed on the stock market. Only 573 have ROC of more than 20%. They have more than 20% ROC, right? You can save this query here. You can save this query and you can give it a name, and that will be saved, right? So you can say that this is high ROC businesses, and that will get saved. Yeah. Next question.
There's a question on how to calculate intrinsic value, but I think the whole DCF needs to be there, so we won't be covering this. It's a vast topic.
I'll tell you the gist of it. I'll tell you. I took a like entire like 1 hour long session on DCF, taught students DCF, but the gist of it is this: if earning is growing super fast, EPS is growing super fast, DCF takes care of itself. DCF takes care of itself. Valuation takes care of itself. You need not even worry about valuation.
So if I were to say in simple terms, EPS growth is what matters.
EPS growth is the ultimate goal.
Yeah, awesome. And I won't be picking up questions on individual stocks because they'll be taking up time. You can post that on community. We'll be answering over there. We won't be answering individual stocks over here. And Mayur is saying stock price formula. एक example दे दीजिए.
मतलब?
I think he's talking about a P into EPS stock price.
अच्छा वो तो कोई भी कोई है. You tell me which one to open.
मयूर आप बता दीजिए कौन सा स्टॉक उठाएं.
I'll share the query also. So let's open page industries only. We just saw that.
We'll share the query. No worries. All the relevant material, the recorded content PPT query will be shared in the community, and it won't be shared just right now. It will take like a couple of days. By tomorrow it will be shared mostly, right?
This is the stock P 99.4. This is the perception of the market. Utility of the stock, earning per share is 395. Multiplied perception with utility, you will get 39,295. You can do the calculation. 395 multiplied by 100, close to 100 will be 39,500. So it is 99.4. So thoda sa kam hai.
Yep.
P into EPS is stock current price. Simple, no?
And there's an interesting question by Adil. Do micro caps have lower rating? Do micro caps have lower rating?
Do micro caps have lower rating as in lower P rating, lower P ratio?
Just let me check. Adil, can you just tell? Are you
or
looking
let's say
out?
lower credit rating? What is that rating?
Yeah, he had mentioned it in the chat earlier, so I'm looking
They
for that.
definitely have lower credit rating, so they don't get loans easily because the size of the company also determines how stable you are financially. Yeah. If your question is, do they get lower P rating? Not true. A lot of micro caps get very high P rating also.
Yeah.
Book value, I just explained. Book value is nothing but assets minus liabilities.
So earlier Adil asked a question on stock, so I didn't pick it up at earlier point. But I mentioned he checked Kanchi Kapuram. It was mentioned there did not cooperate with the rating agencies. Is it okay for micro cap? So I think based on that, he's asking about credit.
Yeah, micro cap. Why do you want to invest? Stay away from like micro caps for long term. But what is the name of the company? Kachi.
Yeah, Kanchi Kapuram.
I am not getting these. Kanchi.
Yeah, first one.
It's a 350 crore company. Market cap is 350 crores. Why do you want to even go there? It's a very small company.
We can anyways, once it grows, we can jump in, right? If we see that it is growing.
EPS is growing, but so we have to wait like till they become a slightly mature company.
Yeah. Awesome. So firstly, thanks Akshay for this wonderful session again. For taking the last and the first session, amazing sessions, and thanks for telling us all about screeners and how we can utilize that in an effective manner. Because I think it becomes a lot hard if you go by the conventional means of analyzing every company individually. Yeah. So screener comes into play a lot better if we have a proper understanding, right? And thanks to everyone who stayed till the end. All those doubts which you have, you can ask them in the community. I've shared the link to join community in the respective group. I'll be sharing it again, right? And I'll be sharing the recordings. I'll be sharing the content directly in the community, but it won't be like done right now. It'll take some time till maybe till tomorrow. And thanks again, everyone, for joining. Great to see a lot of faces who have come from a long time back. And yep, I'll share.
And one more thing, Arvind, one more thing. So next time, whenever we do sessions, I assure you, from let's say a founder perspective, we will stick to the time. I know we are very bad in dealing with time, and a lot of people have commitments, and that's a mistake that I'm admitting, right? We should stick to time. We should like try to estimate content first and then only conduct the sessions. So we will definitely stick to time. This is a feedback that I've accepted. This is mistakes that we have done, even in previous boot camps, right? Next time, whenever you attend a session, we will stick to time, right? We'll try to cover whatever content in the given time, right?
We'll try to stick to time. We'll try, I think is the better word. Not sure we will stick, but yeah.
No, I'm assuring you, we'll do that change. We'll make that happen.
Okay. We'll definitely try. So yeah, amazing and great to have this wonderful 6, 7, 8 hours of learning, and you all were here. Amazing to have 66 people still here. I'll be sharing a feedback form with you guys. I hope you all fill it. Join the community. All the respective details will be shared there. Your teachers will be present there, and you can like properly interact over there and ask all the queries which you have related to anything in financial domain currently, what we have all been taught about, right? And awesome.
Yeah. Awesome. Thank you. Take care. Good night.